Welcome to Supreme Court Opinions. In this episode, you'll hear the court's opinion in Connelly v. United States. In this case, the court considered this issue: should the proceeds of a life insurance policy taken out by a closely held corporation on a shareholder in order to facilitate the redemption of the shareholder's stock be considered a corporate asset when calculating the value of the shareholder's shares for purposes of the federal estate tax? The case was decided on June 6, 2024. The Supreme Court held that a corporation's contractual obligation to redeem shares is not necessarily a liability that reduces a corporation's value for purposes of the federal estate tax. Justice Clarence Thomas authored the unanimous opinion of the court. A share buyback at fair market value does not economically impact any shareholder. Although the remaining shareholders have a larger ownership percentage in a less valuable company following the buyback, the value of their holdings remains the same. Moreover, a hypothetical buyer of the shares pre-buyback would pay full price, knowing they could later redeem the shares from the company at that same fair market value. Furthermore, the deceased shareholder's shares must be valued just prior to death, before the buyback occurs, not after. At that point, the life insurance proceeds are still a company asset that increases share value. The court rejected the argument that the buyback obligation is a liability that offsets the life insurance asset, noting that a stock buyback by definition reduces a company's value and concentrates ownership among fewer shares. Consequently, in this case, the company's obligation to buy back the shares using life insurance proceeds does not reduce the taxable value of the deceased shareholder's stock at the time of death, as the insurance remains a company asset at that point. While acknowledging that this decision could make succession planning more challenging, the court pointed out that shareholders could have used alternate arrangements, such as a cross-purchase agreement, to avoid this particular tax outcome. The opinion is presented here in its entirety, but with citations omitted. If you appreciate this episode, please subscribe. Thank you. Justice Thomas delivered the opinion of the court. Michael and Thomas Connelly owned a building supply corporation. The brothers entered into an agreement to ensure that the company would stay in the family if either brother died. Under that agreement, the corporation could be required to redeem, i.e., purchase, the deceased brother's shares. To fund the possible share redemption, the corporation obtained life insurance on each brother. After Michael died, a narrow dispute arose over how to value his shares for calculating the estate tax. The central question is whether the corporation's obligation to redeem Michael's shares was a liability that decreased the value of those shares. We conclude that it was not and therefore affirm. Congress has long imposed a tax on the transfer of the taxable estate of every decedent who is a citizen or resident of the United States. A decedent's taxable estate is the value of all property, real or personal, tangible or intangible, owned by the decedent at the time of his death, minus applicable deductions. Imposing the estate tax thus requires calculating the value of the property in the decedent's estate. In general, the lodestar for that assessment is fair market value, which is the price at which the property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or to sell and both having reasonable knowledge of relevant facts. A decedent's taxable estate includes his shares in a closely held corporation. Closely held corporations ordinarily have only a few shareholders, often within the same family, and, unlike public corporations, those shareholders typically participate in the corporation's day-to-day management. Given this close working relationship, shareholders sometimes enter into an agreement to restrict the transfer of shares to outside investors. One such arrangement involves giving the corporation or the other shareholders the right to purchase the shares of a holder on his death. A related arrangement, called a share redemption agreement, contractually requires a corporation to repurchase a deceased shareholder's shares. Although such an agreement may delineate how to set a price for the shares, it is ordinarily not dispositive for valuing the decedent's shares for the estate tax. As a general rule, the fair market value of the corporation determines the value of the shares, and one must therefore consider the company's net worth, prospective earning power and dividend-paying capacity, and other relevant factors, including proceeds of life insurance policies payable to the company. Brothers Michael and Thomas Connelly were the sole shareholders in Crown Sea Supply, a small but successful building supply corporation in St. Louis, Missouri. Michael owned 77.18% of Crown's outstanding shares, 385.9 out of 500 shares, and Thomas owned the remaining 22.82%, 114.1 shares. The brothers entered into an agreement with Crown to ensure a smooth transition of ownership and keep Crown in the family in the event one of the brothers died. The agreement provided that if either Michael or Thomas died, the surviving brother would have the option to purchase the deceased brother's shares, and, if the surviving brother declined to do so, then Crown itself would be contractually required to redeem the shares. With an exception not relevant here, The agreement specified that the redemption price for each share would be based upon an outside appraisal of Crown's fair market value. To ensure that Crown would have enough money to redeem the shares if required, Crown obtained $3.5 million in life insurance on each brother. When Michael died in 2013, Thomas opted not to purchase Michael's shares. As a result, Crown was obligated under the agreement to redeem Michael's shares, rather than secure an outside appraisal of the company's fair market value, as the agreement contemplated. Michael's son and Thomas agreed in an amicable and expeditious manner that the value of Michael's shares was $3 million. Crown then used $3 million of the life insurance proceeds to redeem Michael's shares, leaving Thomas as Crown's sole shareholder. As the executor of Michael's estate, Thomas then filed a federal tax return for the estate. The return reported the value of Michael's shares as $3 million, in accordance with the agreement between Michael's son and Thomas. The Internal Revenue Service, IRS, audited the return. During the audit, Thomas obtained a valuation from an accounting firm. The firm's analyst took as given the holding in Estate of Blount v. Commissioner, which concluded that insurance proceeds should be deducted from the value of a corporation when they are offset by an obligation to pay those proceeds to the estate in a stock buyout. The analyst thus excluded the $3 million in insurance proceeds used to redeem Michael's shares, and determined that Crown's fair market value at Michael's death was $3.86 million. Because Michael held a 77.18% ownership interest, the analyst calculated the value of Michael's shares as approximately $3 million. The IRS took a different view, insisting that Crown's redemption obligation did not offset the life insurance proceeds. The IRS counted the $3 million in life insurance proceeds excluded by the analyst and assessed Crown's total value as $6.86 million. And, the IRS thus calculated the value of Michael's shares as $5.3 million. Based on this higher valuation, the IRS determined that the estate owed an additional $889,914 in taxes. The estate paid the deficiency and Thomas, acting as executor, sued the United States for a refund. As relevant, Thomas argued that the $3 million in life insurance proceeds used to redeem Michael's shares should not be counted when calculating the value of those shares. The district court granted summary judgment to the government, concluding that Michael's estate was not entitled to a refund. The court held that the $3 million in life insurance proceeds must be counted to accurately value Michael's shares. It explained that, under customary valuation principles, Crown's obligation to redeem Michael's shares was not a liability that reduced the corporation's fair market value. The court therefore held that Crown's redemption obligation did not offset the life insurance proceeds. The Court of Appeals affirmed on the same basis. We granted certiorari to address whether life insurance proceeds that will be used to redeem a decedent's shares must be included when calculating the value of those shares for purposes of the federal estate tax. We now affirm. The dispute in this case is narrow. All agree that, when calculating the federal estate tax, the value of a decedent's shares in a closely held corporation must reflect the corporation's fair market value. And, all agree that life insurance proceeds payable to a corporation are an asset that increases the corporation's fair market value. The only question is whether Crown's contractual obligation to redeem Michael's shares at fair market value offsets the value of life insurance proceeds committed to funding that redemption. Thomas argues that a contractual obligation to redeem shares is a liability that offsets the value of life insurance proceeds used to fulfill that obligation. He accordingly contends that anyone purchasing a subset of the corporation's shares would treat the two as canceling each other out. By contrast, the government argues that Crown's obligation to pay for Michael's shares did not reduce the value of those shares. It contends that no real-world buyer or seller would have viewed the redemption obligation as an offsetting liability. We agree with the government. An obligation to redeem shares at fair market value does not offset the value of life insurance proceeds set aside for the redemption because a share redemption at fair market value does not affect any shareholder's economic interest. A simple example proves the point. Consider a corporation with one asset, $10 million in cash, and two shareholders, A and B, who own 80 and 20 shares respectively. Each individual share is worth $100,000, $10 million divided by 100 shares. So, A's shares are worth $8 million, 80 shares x $100,000, and B's shares are worth $2 million, 20 shares x $100,000. To redeem B's shares at fair market value, the corporation would thus have to pay B $2 million. After the redemption, A would be the sole shareholder in a corporation worth $8 million and with 80 outstanding shares. A's shares would still be worth $100,000 each, $8 million divided by 80 shares. Economically, the redemption would have no impact on either shareholder. The value of the shareholder's interests after the redemption, A's 80 shares and B's $2 million in cash, would be equal to the value of their respective interests in the corporation before the redemption. Thus, a corporation's contractual obligation to redeem shares at fair market value does not reduce the value of those shares in and of itself. Because a fair market value redemption has no effect on any shareholder's economic interest, no willing buyer purchasing Michael's shares would have treated Crown's obligation to redeem Michael's shares at fair market value as a factor that reduced the value of those shares. At the time of Michael's death, Crown was worth $6.86 million, $3 million in life insurance proceeds earmarked for the redemption plus $3.86 million in other assets and income-generating potential. Anyone purchasing Michael's shares would acquire a 77.18% stake in a company worth $6.86 million, along with Crown's obligation to redeem those shares at fair market value. A buyer would therefore pay up to $5.3 million for Michael's shares, $6.86 million x 0.7718 I.e., the value the buyer could expect to receive in exchange for Michael's shares when Crown redeemed them at fair market value. We thus conclude that Crown's promise to redeem Michael's shares at fair market value did not reduce the value of those shares. Thomas resists this straightforward conclusion. He suggests that Crown's redemption obligation would make it impossible for a hypothetical buyer seeking to purchase 77.18% of Crown to capture the full value of the insurance proceeds. That is so, according to Thomas, because the insurance proceeds would leave the company as soon as they arrive to complete the redemption. He argues that the buyer would thus not consider proceeds that would be used for redemption as net assets. In other words, Thomas views the relevant inquiry as what a buyer would pay for shares that make up the same percentage of a less valuable corporation that exists after the redemption. But, for calculating the estate tax, the whole point is to assess how much Michael's shares were worth at the time that he died, before Crown spent $3 million on the redemption payment. A hypothetical buyer would thus treat the life insurance proceeds that would be used to redeem Michael's shares as a net asset. Moreover, Thomas's argument that the redemption obligation was a liability cannot be reconciled with the basic mechanics of a stock redemption. As the district court explained, when a shareholder redeems his shares, he is essentially cashing out his shares of ownership in the company and its assets. That transaction necessarily reduces a corporation's total value. And, because there are fewer outstanding shares after the redemption, the remaining shareholders are left with a larger proportional ownership interest in the less valuable corporation. Thomas's understanding, however, would turn this ordinary process upside down. In Thomas's view, Crown's redemption of Michael's shares left Thomas with a larger ownership stake in a company with the same value as before the redemption. Thomas argues that Crown was worth only $3.86 million before the redemption, and thus that Michael's shares were worth approximately $3 million, $3.86 million x 0.7718. But, he also argues that Crown was worth $3.86 million after Michael's shares were redeemed. That cannot be right. A corporation that pays out $3 million to redeem shares should be worth less than before the redemption. Thomas's argument thus cannot be reconciled with an elementary understanding of a stock redemption. Finally, Thomas asserts that affirming the decision below will make succession planning more difficult for closely held corporations. He reasons that if life insurance proceeds earmarked for a share redemption are a net asset for estate tax purposes, then Crown would have needed an insurance policy worth far more than $3 million in order to redeem Michael's shares at fair market value. True enough, but that is simply a consequence of how the Connelly brothers chose to structure their agreement. There were other options. For example, the brothers could have used a cross-purchase agreement, an arrangement in which shareholders agree to purchase each other's shares at death and purchase life insurance policies on each other to fund the agreement. A cross-purchase agreement would have allowed Thomas to purchase Michael's shares and keep Crown in the family, while avoiding the risk that the insurance proceeds would increase the value of Michael's shares. The proceeds would have gone directly to Thomas, not to Crown. But, every arrangement has its own drawbacks. A cross-purchase agreement would have required each brother to pay the premiums for the insurance policy on the other brother, creating a risk that one of them would be unable to do so. And, it would have had its own tax consequences. By opting to have Crown purchase the life insurance policies and pay the premiums, the Connelly brothers guaranteed that the policies would remain in force and that the insurance proceeds would be available to fund the redemption. As we have explained, however, this arrangement also meant that Crown would receive the proceeds and thereby increase the value of Michael's shares. Thomas' concerns about the implications of how he and Michael structured their agreement are therefore misplaced. We hold that Crown's contractual obligation to redeem Michael's shares did not diminish the value of those shares. Because redemption obligations are not necessarily liabilities that reduce a corporation's value for purposes of the federal estate tax, we affirm the judgment of the Court of Appeals. It is so ordered. Thanks for listening. This podcast is not affiliated with the United States Supreme Court or its staff in any way. The summary of this opinion given in the introduction was taken from the summary provided at oyez.org. Any mistakes in the opinion you just heard should be attributed to this podcast. If you would like to support my efforts to make Supreme Court opinions available to the public, please subscribe. Thank you.